Good, good morning, everyone. Warm welcome to each one of you. My very esteemed gratitude and welcome to our speaker, CA Bhargava Srinivas. Good morning, everyone. Warm welcome to each one of you. So today we are here to learn about transfer pricing in India and to share our experiences, to learn from the experiences. And if we talk about transfer pricing regulations, they go back to close to 100 years if we talk about the first transfer pricing regulations being introduced in any country. And when we look at IFRS standard, which is very closely connected to transfer pricing, it was introduced more than 40 years ago. And when we talk about UAE, where the regulations are evolving, where it has been few years since the transfer pricing regulations were introduced and it became applicable recently. And the most recent regulations for advanced pricing agreements. So if we look at a subject, this is a subject which is very wide. This is a subject where the regulations or the type of compliance we have to do may differ from company to company depending upon the transactions, depending upon the size of the company. But it is also very important to understand that whatever we are required to be compliant with, whatever documentation we need to have, we have that in place. And and there would be some intriguing issues, some challenges depending upon how the businesses operate, how the relations are there in an organization. So there are a lot of things. And when we look at the experiences of the organizations in different parts of the world, it helps us to understand better. So today we have someone who is a young professional, CA Bhargava Srinivas, who has an experience which is close to 10 years. He's relatively much younger than me, and he is the immediate past chairman of Mysuru branch of the Institute of Chartered Accountants of India. Bhargav practices in India and UAE, and I have started knowing him recently. What I significantly appreciate or like about Bhargava is his will and energy to share so that it helps everyone. And that's what bring Bhargava here, so that we can get an opportunity to listen to someone who is a transfer pricing expert, transfer pricing professional, and a human being who cares to share. So with this, I request you to use emojis to warmly welcome Bhargava today, so that we have a great 1 hour. We are able to create a great value. Thank you, Bhargava, for being here. And before I hand over the screen to you, is there anything you would like to share as your first message?
First of all, thank you for the opportunity. Very grateful, well, humbly grateful. It's always as a chartered accountant when I started my journey and till today. This is my 9th year post qualification. I've always been a learner, and I would like to hope going forward it is always the way I prefer being a learner. So we're lifelong learners of tax. So with this, I thank you. Thanks for all the participants. Thanks our mother body, ICA Dubai chapter, and everybody who has been supportive to me. Thank you so much.
Thank you, Bhargava. The screen is yours, and we are looking forward to this session today. Thank you.
Very good morning, all of you. Uh, so, so transfer pricing is 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 something which has been in place in UAE even before start of corporate tax. I think if you talk to a businessman, a promoter, they were very surprised here in UAE as to what transfer pricing was all about and what is the requirement. However, as long as IFRS has been applicable and we have been reporting related party transaction in our IFRS prepared statements in UAE, transfer pricing as a fundamental concept has always been applicable. It is not applicable from after corporate tax started. So the question as to whether it was applicable, whether it is not applicable, I think it was applicable. The enforceability of the and whether validation probably has started only after corporate tax has been implemented in UAE. Now, just to give you a small brief of relevant legislations in UAE which promote or which create a platform for transfer pricing to be mandated. The first, if you go back to 2020, the Cabinet Resolution number 44 talks about country by country reporting for multinational entities, the groups of multinational entities who have revenue exceeding 3.15 billion dirhams. Now, CBCR, since CBCR reporting is now a mandatory document under Article 55, before 2023, when the corporate tax actually got implemented in UAE, we already had a cabinet resolution which clearly spoke about what is a requirement, who is eligible, who is required by mandate to fill the report and submit it to the authorities. So it was very clear by this cabinet resolution. So which this cabinet resolution is basically brought in here to ensure and to give a fact that we were always in the transfer pricing regime. The enforceability of the regime was not as strict and it was not applicable to everybody. Now let's look at the primary legislation. The whole structure of this session is planned in such a way that I'm sure all of us have finished our one round of audits, which has already gone through and probably vetted by our auditors in UAE. That okay, we have passed through eligibility, we've passed through arm's length principle, and we have passed through the reporting in corporate tax of the first level. That means 1 year we have already had the experience. Now, we at the personal level, at our own firm level, we have had experience of pre-implementation, that is during 2020-21. Post-implementation, we were assisting and advising clients on impact assessment. And during fiscal year ending December 2024, we actually help clients prepare transfer pricing reports, prepare local files, prepare master files, and we were able to submit the same data into our corporate tax returns. So this is the broad experience we want to bring. And of late, we've also advised and supported our clients in tax audits, which FTA has initiated on a number of clients. And these issues, I wanted to share these issues with our fraternity so that we always are updated and we give the right advice to our clients. So so the whole session is planned in such a way that the first 10 minutes I'm going to concentrate on to give you a quick recap of what legislation, what federal decree law, which ministerial decision are we talking about, where do we stand in terms of transfer pricing as on today. Then I will try to talk to you on various issues, TP issues, audit issues, which has cropped up, probably during the implementation phase. And these issues are very corely specific to UAE. I'll try to bring out some experiences across the world, whatever we had, and those experiences of how those were probably transliterated in terms of solving problems in UAE. So the first part is the primary legislation. All of us know that Federal Decree Law 47 of 2022 is the foundation of the corporate tax. All of us, I think, have read it multiple times. Not to waste your time, I'll take 5 minutes out of this. Article 34, Article 35, Article 36, Article 55, and Article 61 are the relevant for purpose of transfer pricing. Now, Article 34 talks about arm's length principle. I'll just go to the next slide. Okay. Article 34 talks about arm's length principle. Now, what is arm's length principle? I'm sure all of us have gone through, understand this very well. I'll give you a quick recap on this. Any contracts, arrangements, agreements entered into by a taxable person, any variety of taxable person, be it a natural person, be it a juridical person, have to make sure that every contract is always at arm's length price. Now, what is arm's length price? I'll give you a very simple example. All of us dream of building a house. Simple example. While building a house, what happens? You have a budget of 2 crores INR. Then you feel short of the funds at the end stages or at the fag end stages. How do you source funds? All of us, the easiest way, I think probably the most easiest way is to source funds from your siblings, your first line of relatives, correct? So I will give you 5 lakhs, you will give me 2 lakhs, maybe 1 year later you give me back. So this is what is lesser than arm's length, correct? So I we have reached a stage where we are thinking that related party transactions are a sin. It is not. It is not. This is how we live. This is how the nature is, and we are destined to do it. What the enforcement authorities are expecting us to be making sure the transactions are always fair. If it's a personal transaction, nobody's asking us to benchmark. Only if it's a commercial transaction, the authorities are asking us to make sure it is fair and justified, fair and equitable. In those cases where contracts and arrangements are not at arm's length, so that is where OECD and our FTA transfer pricing guides give us a number of methods to arrive at arm's length price. Now, so we have around 5 to 6 methods. We have methods in the name of controllable cup method. Then we have TNMM method. We have cost plus method. We have resale price method. We have transactional profit split method. And also it mentions about any other method. Now, these methods are prescribed by OECD, and since UAE is a signatory to the OECD guidelines and authority, so the same download is absolutely being a part of our transfer pricing expectations, transfer pricing regulations. Now, be it OECD or FTA, they talk on the same similar lines. Now, before taking a choice of the method, before taking whether the price of the selection of the price, the most important aspect we have to look in is to the economic circumstances which were underlying for us to undertake this transaction. Whether the functions performed, who among the related parties, who is contributing, whose contribution is higher, who has got expertise in the contribution, who has got bigger risk in the contribution, who is assuming a lot of risk, or who is assuming a very limited risk, who has got assets, be it tangible or intangible assets, and who is holding the asset, or somebody is holding the asset only as a title and possession is with somebody else. So all these matters define and give a proper guidance as to what sort of methods should I choose to arrive at arm's length principle. So for example, when we say assets, let's say for the sake of lower taxes in UAE and maybe simplified economic structures, so somebody would have tried to house the intangible assets in one of the free zones. But does it mean UAE entities really own the asset? or UAE entities really are the real owners of the asset? Substance law always takes the course of substance over form principle, trying to bring out who is the exact owner. If UAE is the owner, UAE has taken the risk of development of the asset, intangible asset. Yes. Now these are the kind of examples which can help us understand under what economic circumstances were contracts undertaken, arrangements performed, or agreements undertaken, so that we always follow, and all our transactions are always at arm's length. Then when then comes the comparables, trying to get a tested party. So who is a tested party among the related parties in the equation? So the most simplest, comprehensive, and the most simplest in the equation will be the tested party. Why is it? Because it gives us the easier achievability of comparables. Ability to find comparables is one of the most important factors in transfer pricing. And find so the more simpler the tested party, it's easier to find a comparable. So this is the broad recap of arm's length principle. And how do we apply the method to arrive is based on these economic circumstances, preparation of a economic analysis, preparation of a FAR analysis, that is functions, assets, risks of each of the enterprises. And that's when it deduces us to selection of the various methods, be it cup method, be it TNMM, be it any sort of the methods what we have been listed either in the OECD or in the FTA, which are both very similar and same. And that is where we arrive at a method and we find a comparable for the tested party. And it is internal comparables versus external comparables are compared to check whether the transaction, whether the income or expenses in the related party are always at arm's length or not. So this is how a broad recap of arm's length principle is being undertaken. I'm going to the next slide. Related parties and control. So most of us, I'm sure, if we are from India background, and if we have learned an income tax law 1961, I'm sure, just giving a small recap of what we would have learned during our student times, that if you remember section 40 capital A2, which talks about payment to relatives, is payment to relatives something which is unreasonable and excessive was disallowed in our income tax law. The same principle, very similar principle, is brought into Article 36, which is payment to connected persons. Now, what is connected person? We'll deal with it. We'll park it for some time. We'll come back to what is related parties. What is the definition of control? Now, so I'm sure all of us would have come across this huge definition of who are related parties. So the law defines or classifies related parties into two broad categories. One is natural persons, the other one is juridical persons. Now, natural persons. So between the two natural persons, who are related parties? So the law takes the degree to fourth level of kinship. Now, you may ask me that probably nowhere in the world, the depth of the relationship is being tested through an arm's length principle of a related party. So that is because UAE family structures are complicated. Now the OECD mother law of transfer pricing has been bent, probably a carve out and carving is pushed into our corporate tax law in such a way that it suits the UAE family style, UAE natural person and their engagement, the families, how it is, how do they operate, and what is their family structure. Now that concept is brought into the natural persons related parties definition. Now, who is going to juridical person? Here you will find multiple combination of natural person and juridical person. Juridical person among them, one or more juridical person. So whether juridical persons directly or indirectly own more than 50% of the other juridical person, or directly, indirectly control the juridical person. Okay, now let me explain it here. I'm sure all of us understand that if somebody wants to control, or somebody wants to own somebody, it is picking up a stake. It's only picking up a stake of more than 50%. But how do they control? How the control is implemented in a juridical person? So, if you read the last line in the slide, you will understand that the meaning of control has been decided very clearly. More than 50% of the voting rights, board of directors composition more than 50%, ability to receive more than 50% of profits, and having a significant influence. Let me give you an example. Let's say one Mr. X is a resident of UAE. So he is a person who is not even a shareholder in the company. He's not even a director in the company. But can he be a related party of the company? The answer is yes, because the word control is can be through a shareholders agreement, where he can always enforce, saying the composition of the board of directors is according to his wishes, ability to control, and ability to influence the decision of the board of directors. He's got the powers over it. Now, somebody who is not a blood relative, somebody who does not own more than 50%, can also be a part of the related party definition without having any of the normal preliminary related party relationships, by having a shareholders agreements, which is typically outside the MOA and AOA what we have. And with that, he's able to decide the voting rights, he's able to decide the composition of the board, he's able to influence the major decisions of the board, which means to say he can enforce control without being a part of the organization. So this is where the law has clearly defined that related parties, or definition of related parties, is not always through a linear relationship, either by ownership or by blood relationship. Even without having ownership, without having a blood relationship, you're still a related party if you are able to control, if you're able to significantly influence the board, if you're significantly influence the members of the organization in order to take a decision which is favorable, which is very favorable to the person who has a shareholders agreement in favor, can still be called a related party. So this is what I want to leave it here for you to think. What else can be the options here? Explore on this. What kind of tools and agreements can be prepared, which can still stay out of the blood relationship or an equity relationship, but however also ability to control without being in an organization. So this is where the control definition always gives you that push. Let us go to our one more definition of payment to connected persons, Article 36. Now, who is a connected person? Our promoters, our directors, and related parties of owner and promoters and directors. Now, why is this important? It is because payment to owners, payment to directors, or payment to related party of owner or the director has to follow and fall under the validation of the arm's length principle. How do we validate? Again, goes back to Article 34. The same principle is applied in validating connected persons. Now, personally, at the personal level, I feel there was no requirement of this section, Article 36. However, uh, because Article 34 is as vast and as inclusive definition rather than an exhaustive definition of the law, where it includes as much as possible, and it is the definition is as wide as possible to include all sorts of transactions which can connect the related parties. But my understanding of why the legislation, the rule makers in UAE have brought this Article 36 is purely considering the style and nature of business in UAE, because we have seen how the local population here, who have multiple companies, who have multiple trade licenses, and trade licenses in free zone, a related trade license also in the mainland. So these are the relationships where people have been taking remuneration over a long period of time, maybe 2 decades. Now, that is the reason this article was specifically brought in to check and validate whether payments taken by directors, related party of directors, promoters, related party of the promoters, have been taking those payments, be it reimbursement, be it remuneration, be it salary, or any other professional consulting management fees in any other whatever form and manner, have always followed arm's length principle as a test to ensure arm's length principle is always followed. So I leave it here. Leave it here. Any further questions, we'll take it at the later. But this is the basic quick recap of Article 34, 35, 36. Now, let's go to the next important, relevant article in the corporate tax law. That is Article 55. That's about transfer pricing documentation. Like with the start of this session, I told you that I spoke to you regarding long before the start of the corporate tax law. In 2020, the cabinet of UAE had already, by mandate, by a cabinet resolution, Now with Article 55, it has probably downloaded and copy pasted whatever OECD has been saying for the last 10 years, or almost 1.5 decades, through its transfer pricing documentation. Let's look at what are the kinds of documentation. One is local file, the second one is master file, third is country by country reporting. Now, what is local file? Local file defines the local entity. So if entity has got a residence in UAE and related parties outside the country, a local file becomes mandatory to be prepared by the entity. What is a master file? If a group company less than 3.15 billion AED has got a headquarters in Dubai or Abu Dhabi or inside UAE. So master file is a reconciliation of the local files across the world. If let's say for the sake of brevity, say for simple example, our Abu Dhabi Investment Authority or a Central Bank of Dubai has got entities which it has invested in India, Singapore, Hong Kong, in US and multiple places, and it has got business operations, and it has invested in multiple entities across the world. Those entities will prepare local files which has got transactions with the related party at the local level. Now, these entities will prepare local file, and UAE headquartered entity, be it I said Central Bank of Dubai or your Abu Dhabi Investment Authority, will prepare a master file which will contain all the local files and a reconciliation which will tally to the transactions between all its related party entities across the world. Now, what is country by country reporting? How different is country by country reporting from master file? Country by country reporting is for those specific groups where Pillar 1 and Pillar 2 are applicable, and country by country reporting is mandatory for those groups which have headquartered in UAE, and there's an automatic exchange of information in the OECD where we have to file a report to the OECD through FTA, and this information is almost shared on a live basis. So this is a 3-tier documentation which has been made mandatory in UAE post implementation of corporate tax. Now you'll ask me, if the turnover is, let's say, 500 million am I mandate should I mandatorily prepare transfer pricing documentation? Yes. So if my turnover is below 200 million threshold, should I prepare the documentation? I'm telling you, the documentation of local file may not be mandatory, but testing those transactions, whether those transactions fall within the arm's length principle is a question we have to answer. So the whole notion of saying that my turnover is below 200 million, I am not required to prepare a transfer pricing report or a transfer pricing analysis is quite shady and gray, because law clearly says Article 34 is mandatory. And where do we get this threshold limits? I think we get this threshold limits from Ministerial Decision 97 of 2023. Now, why I'm pointing out this very important thing is that in various audits, tax audits where we have been supporting our clients, we have seen clients telling us that we were not even eligible for transfer pricing documentation, but we have been asked. But my question is, did you have transfer pricing matters? Did you have related party transactions? If the answer is yes, even 1 dirham of transaction with related parties will mandatorily push you to do a transfer pricing analysis. So by law, you're mandated that entire books of accounts or all your transactions are always, if there are related party transactions, you're always tested on the arm's length principle. Now, where does the reporting start? The lowest level of reporting starts if your market value or recorded historical value in your financial statements, the related party transactions, the total related party transactions value in aggregate, in total, crosses 40 million, and per category 4 million, and payments to connected person cross 500,000. See, this is the first level of reporting that happens. In your corporate tax returns, there's a separate schedule where it'll ask you the questions saying whether your RP transaction, related party transaction, is crossing 40 million AED. If you click yes, then it'll give you a schedule for where you have to fill up who are the related parties, what is the KYC of them. You'll find the TRN to be uploaded, what is the value which you have transacted, and what is the market value. Now these kind of documents, these kind of values have to be filled in the schedule. So if you have to fill these values, you have to prepare a transfer pricing analysis in advance before the end of the financial year, and be ready to submit this with corporate tax returns. And the next level of reporting is that preparation of local file, master file, or country by country reporting. FTA, if you have more than 200 million turnover, FTA can anytime in the 7 years, the law provides for 7 years, wherein anytime in 7 years they can ask you for this documentation, and you should be able to provide this within 30 days, they ask. And this is a mandate. And many companies we have seen in UAE that it is not seriously taken. Please advise your clients to make sure that they prepare a local file before the completion of the audit and before the attestation work starts. This is something very important. We have seen, and the kind of penalties what FTA is levying, it's very scary. So make sure that local file or master file, as and when applicable, has been always been prepared before, not just an Excel sheet working or a 2-page note by an expert. No, please do not accept these things. Make sure the proper local file, or if you're below 200 million turnover, where your actual mandatory documentation is not relevant, take a TP, transfer pricing analysis, from an expert, keep it with you. I'm very confident that document is going to help you present it to FTA when audit is actually taken up. And if within 30 days very voluntarily. If you do not submit it, the kind of penalties are really scary. And let's not get into that. I'm sure all of you would have done this. Let's go to the next article. I think this is a little uh, only one of those clauses applicable. That is transitional rules. Article 61 talks about transitional rules, where it says balance sheet of the previous financial year, the comparative opening balance should always comply with arm's length principle, which has been stated in the UAE corporate tax law. Now, this was a very important provision which our experience quotes. Our experience, I can quote, majority of the bigger companies have taken a stance that it is not possible to follow for December 2023 financial year, and many auditors have given a qualification that this was not followed. However, we are yet to see what kind of action will be taken by what kind of action will be taken by FTA regarding transitional provisions. With this, we have finished the proper recap of arm's length principle, and now we would like to share. We would like to share with you what issues in our experience. What are those tax audit issues, in especially related to transfer pricing, which will make sense for you to correct it or rectify it or advise the client beforehand that these issues might come up. Okay, this is one of the I'm starting with those issues which are almost there in 95 or 100% of the entities in UAE, which is very common among companies in UAE, be it free zone, be it mainland, be it DIFC, be it ADGM. I'm sure at least for those entities which are of reasonable size, I've always seen these transactions, and I would like to talk to you on on these aspects. So shareholders current account. So what's shareholders current account basically? Now when the promoter starts the business or has been in business for, let's say, 5 years, 10 years. So since promoter, he owns the business, he contributes to the start and continuation of business for quite a long period of time. Now, what comes in initially as equity is purely in the nature of shareholding transaction, where equity contribution enters the bank account of the entity, or it can be in kind if it's incurred in kind. For example, it can be in the nature of plant, it can be in the nature of real estate. Now, what happens later is what the law is probably the issues have cropped up, or where we are heading to. Now, once the business has started, as we move forward, we will see to the fact that many times, maybe due to the working capital pressures or negative working capital, or during a phase where asset is being purchased and promoted without having a third party borrower, or with having a third party borrower, would like to borrow funds or use his personal funds to fund the investment or expansion of the entity. This amounts which actually flow into the organization will be sitting in shareholders current account as credits to the shareholders current account. Now so this becomes a transaction. If we are talking about a independent entity, so the transaction, this nature of transaction, which the promoters or the shareholders bring in money for working capital purposes or capex purposes, this clearly is a related party transaction. Now, what we have concluded that it is a related party transaction, but what we have to conclude is to how do you make an adjustment or whether an adjustment is required, for which we have to do a proper research on the transaction. understanding what the transaction is, analyzing the ledger of the transaction in a very, very accurate manner. Now, once you see the ledger of the transaction where credits to the ledger are there and debits to the ledger are there, we need to understand the nature of the transaction. We need to understand the intention behind the transaction to make a proper adjustment. If it is a working capital support, it's a short-term loan. If it's a capex support, why do you think business will require capex support from the promoter? So it depends on the credit worthiness. If the promoter has got an independent credit worthiness which is better than the organization, and organization requires funds, you have no choice, but the promoter, due to his good credit worthiness, will borrow money at his own side, on his own name, and bring those funds into the organization. Now, this is typically a borrowing, but made by the promoter, introduced as a contribution inside the shareholder's current account. Now, this amount, whatever credits to the current shareholder's current account, has to be classified, has to be understood in the context of the intention behind giving the credit. If it is a short-term loan, in some sense, it is a small equity contribution. If the intention of this amount, if it's a working capital, to pay salaries or to pass the ijari checks, if the intention is to support a short-term loan, I think it is really in the nature of shareholder activity and does not require any great adjustments. Let's understand if it's a capex expansion where machinery is being brought inside or real estate is being bought for the purpose of achieving business objectives. Now, the parallel to be drawn in this case is that if the entity had to borrow the same money from a third party who's not a related party on its own, on its independent creditworthiness, what is the kind of approach it has to take? Whether it has enough creditworthiness in order to make sure that required funds is available or borrowed at the right point of time, at the right period, and has it got enough working capital requirements, or is it got enough positive working capital in order to fund the initial borrowing and also pay the EMIs as we go forward. Now, this is the kind of analysis you have to make before making any transfer pricing adjustments for transactions like shareholders current account. If you're able to accurately delineate the transaction, which means to say that you'll have to investigate, take out, make a surgery, pick up the transaction and understand transaction by transaction, then I'm sure you'll be able to understand the intention behind bringing this money inside the organization. Now, that is what gives us the exact reason. And that is what makes us understand what were those economic circumstances which were behind undertaking this transaction. If you're able to do it, I'm sure you will come out with what kind of treatment the transaction has to be undertaken, whether it is in the form of equity, whether it's in the form of short-term loan, whether it's in the form of long-term loan, whether the interest has to be charged. All this will, I think, all this post thoughts, you will get it only after you perform this procedure before assessing whether the adjustment is required. Now I've out of my experience, if you read the last fourth paragraph, I have given you a technical warning because promoters have put money long back, but the debit balances, that means the owner has taken money back, but interest portion remains uncharged for long years. It is frequently recharacterized as deemed dividend, which is not deductible for the company, potentially taxable for the recipient. Now, think about it. Is FTA being wrong? I think the intention of the transaction was very clear. And the debit balances were actually dividends, right? In that case, it has to be treated as dividends. So this is what I want you to understand. This is the depth of the transaction you'll have to go in order to make an assessment before taking a call as to what kind of adjustment needs to be made. Guys, just a minute. I'll just take a small take.
So thank you all for joining. Bhargav will be back with us. Yeah, he's back here, so
Thank
we'll
you. Thank you.
continue.
So going to the next, going to the next. Just a minute. Yeah. Now, I would like to give you my experience on the transaction of managerial remuneration. In fact, a couple of months back, I had particularly written an article in my LinkedIn page on very similar issue, what was raised by FTA and how we had dealt it from the initial stages and what stand made us made what was the stand we had taken and which was successful. So we always call it as benefit purpose test. No, I've written here in the slide as benefit test. I'm telling you benefit purpose test. The literature of international tax or transfer pricing always talks about the whether the benefit has been really passed on. This is a question which remains always unanswered, and that is where we entities always enter into problems. Now, what is managerial remuneration is something which we have to understand. Is managerial remuneration and dividend are one and the same? These are the kind of questions we actually get. Now, I would like to I want you to explore and understand that in UAE, the kind of transactions we have seen in UAE, the law says, please make a comparable to the market value. Now, how do you make a comparable to managerial remuneration? Let's take an example of for example, of a distributor. We have an electronics distributor. So in UAE, electronics distribution is a huge market. Now, can you compare somebody who is importing electronics, let's say from China or from South Korea, versus somebody who is trying to manufacture locally, and the volume of the transaction, can you compare these things? And typically, the law has always hinted at taking comparables. Now, what sort of comparable can I take for a managerial remuneration? So there are so many HR organizations, hiring organizations, which release reports. Which release reports saying what is a suitable salary received by various designations across UAE. So they standardize this format, and they bring about a report every year. So let's say for a manager with 10 years experience or 15 years experience, it says he can draw a million dirham salary. Now, my question is that enough? Is that benchmarking, or can you just straightforward, can you just rely on those HR organizations report, which is mostly, it is a rationalized to or averaging is performed to ensure and enable that whole industry is captured? Are you able to delineate a transaction based purely on the exact function of your organization? Now, this is something very important. So as far as managerial remuneration is concerned, there is no straight jacket approach as to how managerial remuneration has to be benchmarked. So we had taken a stand as to use multiple combination of benchmarkings to arrive at the conclusion. First, level one, we also depend on HR valuation reports, HR hiring reports, which says so much of salary for such a position and such an experience every year. They release it every year. The second nature of the second nature of what was our understanding is to use a profit level indicator in under transactional net margin method. A combination of both arrive at a median and compare internal comparables versus market comparables. If you are able to make this, and I'm sure you'll be able to defend it very comfortably with FTA. So FTA is always concerned whether managerial remuneration will erode the profits, thereby erode the taxes. That is where it comes. So one of my clients was drawing 1.5 million a year. So the question was whether he can issue a bonus for himself for another 1.5 million. The question was not whether money is available in the bank or money is actually in the profit and loss statement. The question was whether he should take it as managerial remuneration or should he take it as dividend. That is the question. The amount of withdrawals made by the manager or made by connected person has to be commercially rational. A benefit purpose test has to be performed in order to ascertain whether the amount of withdrawal is actually in the nature of remuneration or it is a profit withdrawal in the nature of dividend. This is the gray area where we have to make sure we have to pick up the transaction, understand its depth, understand its intention, understand the underlying intention behind the transaction before we apply the transfer pricing adjustments. So this is also one of those cases where under the tax audit, we had an experience of how managerial remuneration was tested by the FTA, and we were able to defend because we were taking multiple stands of multiple methods have been used, and one single method could never be able to be. We were never be able to use one single method to justify the allowability of the managerial remuneration. So that is our experience, and it has been rewarding for the last 1 year that the kind of stand is always conservative and not highly interpretative. Let us keep it simple and conservative. Let's go to the next topic of what I have seen in one of those audits and one of those impact assessments: personal guarantee. Now, what is personal guarantee? It's become any bank. I mean, easiest available transaction. What we have seen. You go to any bank today. Let's say we are 4 directors, 4 director come shareholders. We go to the bank. Let's say we have a 500 million turnover today. Banks will make an assessment of the entity. Will check the credit worthiness of the entity first. Then it finalizes that you have a fantastic organization. Your PL is great. Your EBITDA is great. Your PAT is great. Everything is great. But before giving you the required facilities, before giving you the credit facilities, it will tell you one thing, which is a practice in UAE. It will say, I want personal guarantee of all the promoters. Now, personal guarantee of the promoter, is it extremely implicit, or without a personal guarantee, do you think the entity cannot avail credit facility? Now, this is the question I want you to answer before you measure the economic benefit which the entity has derived from a personal guarantee. All we are trying to understand here in case of personal guarantee is that whether there should be a fee which is justifiable is to be paid to the promoters or anybody who has offered personal guarantee to the entities in UAE. Whether we need to pay a fee or not is a question we have to answer first. And second, if the fee is payable, how do you decide what is the amount of fee is payable? This is a question we are trying to answer in this case of personal guarantee. So when before you start the assessment of personal guarantee, if the transaction has got if the entity what you're assessing has got a credit facility, make sure you get the documents of creditworthiness and read the credit reports very carefully. If the credit reports are good and positive, personal guarantee is only a matter of underlying security to the bank. It's a comfort letter. It's as good as a typical comfort letter, and it is not implicit. When it is not implicit, and when it is not implicit, what is the requirement of payment of a fee? Because there is no measurable economic benefit which is flowing from promoters who give personal guarantee to the entity they own. So if the creditworthiness of the borrower, the LLC company or any other form of organization in UAE is very good and very positive and has got an independent capacity to obtain credit facilities, the personal guarantee agreement or the guarantee offered by the promoters is purely a matter of comfort given to the bank and not an implicit advantage. So therefore, I would like I want you to understand to I want you to make sure when you see a personal guarantee transaction, do not jump to a conclusion that you have to provide a fee to make a transfer pricing adjustment. Please understand the transaction very well. Please dig through the transaction, check where this actual benefit has been passed on. Was there an arising economic benefit which made sure that this benefit of fee was really required? Otherwise, the credit facility could not be availed by the borrower. Let's say the other case, the vice versa case, where we see the credit worthiness of the borrower is not substantive to obtain the credit. Therefore, personal guarantee becomes not just a comfort for the bank, but it becomes a comfort for the entity also. That means, which means to say that without personal guarantee, the banks or the financial institutions will actually not afford to give you the credit facilities. Now, this is where you have to actually check what is the impact, what is the comfort given by the promoters when they offer personal guarantee, since it's absolutely required. Now, you can always check that how much is the fee since there's a measurable economic benefit. Now there's an economic benefit. Before that, let's park measurability. Economic benefit now is actually being passed on by a promoter in the form of personal guarantee to the organization. Now we are sure that fee eligibility is there. How do we measure what is the amount of economic benefit that is being passed on or that is being passed on by the promoters to the entity? How do you calculate it? We use a very common approach called as yield method, where which calculates actual benefit. That means without personal guarantee, what would have been the rate of interest, and with personal guarantee, what is the rate of interest? The difference in the interest is taken as a benefit or the measurability of the personal guarantee, and that is the benefit which has been passed on to the promoters or person who offers personal guarantee. So if you do not, if this process is not adopted by the entity, or at the time of borrowing, it becomes a difficulty about the allowability of the expenses. So why do we say this is because the consistency principle, when if you're borrowing, let's say in mid of the financial year, let's say August 2025, you had a borrowing, and you're passing the entries for payment of the benefit in December before closing the books of accounts. Do you really think that the financial statements are, books are prepared on the consistency principle? No, because it is a matter of trying to follow the arm's length principle for the purpose of preparing financial statements. So if you have had a guarantee agreement at the time of availing the credit facilities, then I am sure with a formal guarantee agreement of fees which is already determined, I am sure that will become an allowable expenditure. So that's about personal guarantee. Let's go to the next option. So can I a lot of chats? Is there any questions?
Uh, yeah, Bhargav, I have unmuted everyone. So maybe we'll
Okay.
take the questions towards the end. And at this
Okay.
point of time, I will request the participants to be here. We may extend by 15 minutes so that after you finish, we can take few questions. Yeah. Okay.
Sure. Okay. Okay.
Thank
Just a minute. So going to the next issue where we have seen is a management fee. So now we have a clear distinction between who is a owner and who is a manager. This probably is visible in those companies or group level companies where the shareholder activities are very much different from the management activities. But whether the value addition is a question which we have to always answer before understanding the management fee. Let's understand how does this work. There was a very similar amendment in VAT also, I think a couple of years ago. So I think we had a notification from FTA as to how the management fee has to be allocated, apportioned between the group entities. Now let me give you a simple story of what management fee is. Let's say the group company, group company which makes investments across multiple entities. For example, Landmark Group has got some 16, 17 large entities, and the group level management which oversees the operations, which oversees the finance functions, which oversees the HR functions, and they may have a back office support. I have one of my clients where we were working with who has a back office support in Egypt, back office support in India, back office support in Philippines. Now there's a management sitting there also. Now, these are the kind of activities management really performs. And you have to make sure it is not shareholder activities. For example, consolidation at the group level is a shareholder activity and not a management activity. So make sure you're able to delineate the transaction as to whether is it a shareholder activity or it's a management activity. Very important before you start and understand this transaction. So once you make this, so OECD gives you a broad guidelines on what is called as low value adding services or not. So you can. So the OECD actually lists what is LVAs. I mean, in short, low value added services, and what is not low value added services. If you are able to classify management activity, for example, somebody is handling back office support, somebody is managing a call center on an operational basis. If you are able to say this is not a value adding service, so you can follow a simple cost plus method of 5% on the total cost without making any comparable study, without making any benchmarking study, which is more complex. So, but ability to understand and determine what is low value added services and what is not is always dependent on the case in front of you. Ability to make sure and delineate a transaction between shareholders' activities, between managerial remuneration, which is Article 36, or a management fee. If you're able to clearly distinguish between three and make sure to draw borders between three kinds of transactions, I'm sure you'll be able to understand whether management fee will fall under LVAS or non-LVAS. So, however, even after you classify whether it is LVAS or non-LVAS, make sure there is an agreement which formalizes the benefit. the agreement always talks about what is the kind of expectation from the management. It is always brought down to words. It is always not in an email, make sure there's a whenever a relationship between group company and subsidiary company overseeing operations, overseeing the risk of the operations, the activity has got a different responsibilities. Make sure you document what is responsibility, what is accountable, and what is duty, what is liability. All if you're able to document this in a very, very comprehensive manner, and your transfer pricing policy at the group level aligns very with the service agreements, I'm sure you will always be able to defend the audit and the transaction adjustments what you have taken. So this is where management fee talks about. Let's park this here and go to the next one. Okay, this is one of my favorites, my personal favorites. Intangibles. If you remember my conversation, what is intangible? Let's take it through. What is intangibles exactly? So intangibles is basically those assets which enable. There's a development of it, which enable you to perform business across multiple jurisdictions by using it, by leasing it, or by owning it. I'm sure I'll take some time on this because this is one of those things which a lot of free zone companies have come across, which have housed intangibles, at least for the purpose of ownership across the GCC region, and leasing of it happens from Dubai, especially in the free zones of Dubai. Now, this is something which is very critical to understand. Who is a person who has developed intellectual property? Very important. For example, let's say Dubai has the capacity to do it. It can outsource it to Philippines, India, or Egypt for development on a contract basis. So that itself becomes a different transaction than ownership of intangibles. So by allowing a contract cost, outsourced contract cost to entities in India, Philippines, or Egypt to develop the intangible is a contract cost, which is a separate transaction. But however, you own the intangible after the development in Dubai is a totally different transaction. Now, I have just classified how and what examples or a small note I have made of Dempe functions, especially for in case of intangibles. Let's say development, actual creation of the IP happens in various R&D centers across the world. Enhancement, once the basic development has happened, the enhancement can happen there, or enhancement can happen locally in Dubai. Maintenance, protection, and exploitation. So let's understand that exploitation is where you generate revenue. For example, once the contract or outsourced contract to develop the intangibles is completed in one of those countries, you own the asset here in Dubai because of the free zone provisions. For the beneficial free zone provisions, you own the asset inside, let's say, DIFC free zone or ADGM free zones. Now, once the exploitation of the intellectual property happens, revenue starts getting generated. Now, there are cases where we have personally seen where, because of the beneficial tax rates or beneficial banking operation style, or you can say that Dubai or UAE as a very safe for businesses, a lot of businesses park their IP inside UAE, and whether by title or whether by transfer or whether by possession, is all the three aspects do they own intangibles is a question you have to answer yourself. Is it for the sake of accumulating the revenue in UAE, or is it actually let's say the IP is worth $1 trillion, or let's say 500 billion. Is it actually staying in UAE, or is it for the namesake it's staying in UAE? A simple example, all of us know Google is a US company, but the billing happens from Ireland, correct? So if you want to make sure I own the Samsung technology, but I want to place it or house it inside a free zone entity in UAE. So I should ensure it'll not be without a substance. Two people on the paper and nobody else. Only profits keep coming here. Then it is very critical and difficult to understand the ownership. You cannot classify the ownership as within the UAE. It typically law always takes substance over form, and it will always consider and disregard the ownership. And always the disregarding of ownership happens very clearly across the world, because we have pillar 2 provisions which talk about income inclusion rules. Now, this is where Dempe functions for intangibles makes it very critical for you to understand who created it, who owns it, where the leasing is happening. So please make sure and understand that every part is documented, and your group TP policy always aligns with the Dempe functions when it is being developed, maintained, or exploited. Let's go to the next one. So in our experience, I wanted to talk about supply chain issues, because we see a lot of distribution, especially in Jebel Ali Port, or if you see in the mainland, a lot of distribution based business there, where there are many MNCs who have a limited risk distributor. You'll have a limited risk distributor. Who's a limited risk distributor? Is that it's typically like a C&F agent, but a branch of a foreign company sitting in UAE, okay, or a limited branch. Now, just a minute. So now let's understand what are the characteristics. How do we be able to decide what is a risk assumed? What is my first attribute I'm trying to test is a risk assessment. How much of risk is being borne by the distributor in UAE? Let's say very low, extremely low, and he does not even maintain a proper inventory. So absolutely, he should never bear any losses. What is the asset use? Extremely basic warehousing equipment and nothing else. Routine, very routine. So return on operating costs and not on the intangible function. What is a loss justification if such a limited risk distributor is sitting in UAE, sitting in, let's say, a Jebel Ali free zone? How can you justify a loss? It's an extremely very, very rare loss, because there's no function given to you. There's no responsibility given to you. A loss cannot be pushed. That means if loss is being incurred by that entity, it has been a deliberate push of loss on the global level. This is what I want you to keep your eyes open. If the function of the entity is very small, very limited, then the loss also has to be very small or no loss. If somebody is having such a limited function, limited asset, you keep your eyes open, saying this is peculiar pushing of losses to this entity and nothing else. So these are the kind of things we have seen, and I'm just sharing with you. So procurement hubs, this is something which we have seen in UAE. I just give it. So procurement hubs, whether justifying a market of 5% of market for UAE procurement office that only handles paperwork and no inventory. Let's say there's a proper procurement hub. You have a BL and distribution for entire MENA region. And it's only a procurement hub. It does not perform any other functions. Can you justify 5%? Just with two resources, not even an accountant, not even a biller. Biller will be sitting in some Egypt, and everything is wide and distributed function. What is the capacity? What is the function of a procurement hub is very important if you want to have a 5% markup. Even a 5% markup deserves a function which is more responsible than just having a billing center, a re-invoicing center. I'm going to the next one. This is also for you to read. It's quite simple. The role of principal and agent. When a group entity manages transports and logistics for affiliates, why I'm using the word affiliates is very critical, not just for related parties, even for, I said people with control, non-control through non-related parties. The pricing of these services was distinguished between principal and agent role. If the entity merely coordinates third-party shipping without assuming operational or financial risk. Like I said, the function, asset, and risk analysis is very, very critical to delineate the transaction. Please make a surgery of the transaction. Pick up each part of the transaction to understand how risky or how simple and how limited it is. All possible things, and it is generally entitled to the modest service fee or a small markup on coordination effort itself. So this is where I want you to think and explore that not every transaction, unless it looks like, and most of it I've always seen people talking about applying a PLI of OP by OC and TNMM is the final, nail in the coffin for the TP reports. No, please do not do it. Make sure you understand the transaction. I'm always telling people, please do a surgery of the transaction, open it and see it, what is there. Unless you open it and see it, what is there, what is the intention, who is the person who is taking the risk, and who is the person who is receiving the benefit, who wants the asset, and what is the exact function of the entity in the UAE makes a lot of difference. Go to the next one, inventory obsolescence. This is seen in pharma distributors. Contract manufacturing. This is something I wanted to bring it to you. Contract manufacturing is a very low profile, but in UAE, what we have seen in our experience is that contract manufacturing is usually handed over to Philippines, where the facility of producing goods on behalf of the principal. People would have, even UAE entities would have invested in the manufacturing unit also. So who owns the risk? Who owns the risk is the question what you have to ultimately answer. So please make sure that risk assumption is analyzed extremely well in these cases. Contract manufacturing is extremely widely prevalent in pharma companies, and especially in pharma companies. I think a lot of contract manufacturing happens in Hyderabad, where a lot of pharma companies have housed their patents in UAE, and the manufacturing happens in India, in Hyderabad and Andhra Pradesh areas. I think this is what we have seen. And make sure who owns the risk is being the risk assumption feature is well analyzed. Right. So pass-through cost, very, very important. So when we talk about management fee, we talk about reimbursement, whether warehousing costs, which are often treated as pass-through costs when one entity pays a third party and recharge of those costs to the party. Under international guidelines, the markup is typically only applicable if recharging entity adds specific value. That means if the function is routine or function is only passing through something where the risk assumption is very less, I don't think unless it is a pass-through cost, nothing else is there. So value addition for the warehousing is something which I want you to check. If with the function, please check whether the function of this entity is very clearly other than warehousing or anything else is there in terms of risk assumption. So if you're not able to distinguish between value-added services and disbursements, I am sure disallowance is guaranteed for you during audit. So please make sure during the warehouse costs, pass-through costs of warehouses, whether there is any value. For example, if it's a cold storage, is the value addition there? If it's it's only a disbursement or reimbursement. Please check on these kind of things. Please do a surgery of the transaction. Warranty charges. Okay, I think I will stop it here, and I think we are exceeding time. I've brought out and will be sharing this with all of you. I think we can start the Q&A session. These are the things what we had come across, and I wanted to share with you. A much more time is required. I would like to stop it here and allow the moderator to take in from here.
Thank you. Bhargav, if you would like to share your slides, can you put on the chat box? If you can share. Your
On the
chat
presentation.
box, presentation, if you are open to share. So that those who so you can share that. Those who wish to take, they can take.
Okay.
I will request now to all who have any questions. We will take 10 minutes and give you time. If you have any question, you can please raise your hand. I'll unmute you, and then we can proceed with it.
Yes.
So, yeah, so we have one hand raised. Let me unmute. Meanwhile, you can share your presentation if you can.
Shall I stop
Uh,
sharing?
yeah, you can stop sharing and share in the chat box. Yeah,
Yeah,
so
one
I'll
second.
unmute Sahil first. Yeah,
Second. I'm
Sahil,
just.
can you try to see? Can you unmute yourself, Sahil? Now? Where is Sahil gone? Okay, Sahil is not here. Yeah, Bhupesh, can you go ahead with your question?
Hi, thanks for this
Hey.
informative session. Thanks, Bhargava. Thanks, Prabhdeep Ji. Well, you were talking about the personal guarantees given to banks and all. If banks have comfort level, then you cannot charge it. If companies having very good credit worthiness, they should not charge any money for it. The question is that if a bank, despite being very, very good credit worthy, bank is saying, forget it. Unless you give bank guarantee, personal guarantee, I'm not giving you finance, then where the comfort level comes up? Even if
Okay.
I'm the best of the company, as far as I know, only maybe big business houses like Al Futems and all are not giving personal guarantees. Almost every expect is giving personal guarantee promoter. Where it comes up? Banks
Okay.
are forcing us.
I understand. I understand your question. I mean, we have seen this in many clients where we have always advised. See, unless the top tier companies, if you exclude them, the mid size, the small size, no bank in UAE is giving loans or credit facilities without giving a personal guarantee. The
Exactly.
exact. I think we're on the same page. Okay. Now
Yeah.
my thinking is that we have to check whether the giving a personal guarantee is actually adding value or it's a comfort zone for the bank. So without giving the personal guarantee, was the entity independently eligible for the loan or credit facility? This is the question you have to answer. Check the credit
Uh,
reports. Please allow me to 2 seconds.
yeah, sure, sure.
Please check the credit reports, and if credit reports are good and credit reports give you the eligibility, the personal guarantee is only a matter of comfort. I mean, this has been clarified by FTA in its meetings, in its seminars, and also in the FTA guide. And this is what is the interaction we've had with the FTA authorities. Also, this is our we are sharing this out of our experience. So unless the credit worthiness of the borrower is bad, that's when the personal guarantee fees has to be charged. So just because personal guarantee is given by the promoters, a fee is being charged does not give you allowing of the deduction in that case.
But again, I'm just saying one more thing. When my lender is telling me, forget it, don't think of getting this money. That means you
Okay.
stop doing your business, and that means you're essentially required to get the money. You have to sign off this paper. Then how
Correct.
come it
Correct.
goes
I'm,
up the
I'm, I'm
company?
not I'm not I'm not denying. I
I
absolutely
have seen
understand.
the companies. I've seen the companies which had no borrowing and very very high credit rating. Not now. At that time, there was nothing mattered. Maybe 15 years back, and bank said, "Forget it. Give me guarantees. Then only personal guarantee. Then only I will
See
move
the
forward." That makes it mandatory. It's like a fee is being paid to bank. So why not a fee being paid to promoter? Because he's giving guarantee.
Bhupesh, yeah, Bhupesh, maybe we have few more hands. Maybe you can personally take it with Bhargav later. Yeah,
Sure, sure. Bhargav,
yeah,
please. We can only take
yeah,
because
yeah,
I need
yeah,
to.
yeah.
Compulsion of
Fine,
doing business makes it a mandatory business expense for me.
thank you.
That's what
Yeah,
is my
so
criteria is.
okay, Vineet, can you try to unmute yourself? Vineet,
Yeah,
yeah,
yes, yes. Yeah. Thank you, Bhargav. It was a nice and insightful section. I
Thank
have a
you.
questions related to this disclosure requirement. So at the end of the year, along with the return, if that based on the threshold that 40 million and 4 million, when we calculate, should we include the receivable balance along with the during the year transaction, receivable or payable balance while calculating the threshold, or simply during the year transactions?
During the current year transaction.
Only current year transaction.
Only
No
current year
need
transaction.
to.
No, 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 no. Current year transaction only.
Okay, 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 fine. Understood. Thank you. Thank you.
thank you. Vamsi, can you please unmute yourself? Yeah.
Thank you. Yeah, I can unmute. Hi, Bhargav. Thank you for the session. See, I have a query regarding intercompany related transactions. Let's say we have a subsidiary where the share capital is very minimum. As per the law, it's hardly 100,000. But the investment, initial investment, let's say we kept around 50, 60 million. That was during the initial stages for the business to have a proper capex and all. See, the thing is, in the subsidiary books it was shown as like a shareholder current account, or as like a non-reciprocal capital contribution. That's what auditors were showing in the books, which we don't charge any interest on loan, although it looks like a loan, but it's not actually a loan. It's more like a capital contribution only. But legally speaking, our capital is only 100,000. Rest all 50, 60 million, whatever is kept in given to the subsidiary, it's more like a loan kind only. We cannot say it's a capital, but it's more like a capital to the company. Now, for this, for the transfer pricing and all, I mean, like whenever they say you have to charge an arm's length, interest on your loans. I mean, like, will it cause any trouble in the future for this kind of transaction, which is very common in UAE? I just want some, thoughts on it. Like how, I mean, like what procedure if we follow so that we'll not get any headache in the future.
Very, 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 very prevalent style of business in UAE. This is. See, if you've read Article 61 transitional provisions, that is, if your year end is December 23, I'm just starting from a little introduction. December 23, the law says you already had to comply with arm's length principle even before start of your corporate tax, assuming December 24 is your first year where corporate tax was applicable. Now, December 23 balance sheet, if you had actually applied arm's length principle, you had no choice, or typically you have two choices. One, convert it into capital. Two, apply interest. Check the credit worthiness, apply interest. If December 23 you have not done that, first level violation is that. The second level is that, you see, now intention is very clear. It is not, it's an irrevocable fund. That means the fund is not going to go back from subsidiary to holding company, which means that it is typically in the nature of capital. So my suggestion is, instead of charging interest, please change it to upgrade it to capital. This is, so many companies have already done this. Or if the holding company is planning to get it back, then create a proper documentation with an annuity procedure. If not, please convert it into capital and put an end to this long outstanding things we're sitting in the balance sheet.
Okay, thank you, Vamsi. Ajay, can you please unmute yourself and ask? Yeah, Ajay, are you there?
Yes,
Yes.
I'm here.
Yes.
Yeah.
Yes.
Thanks for giving the opportunity. Thanks for giving the opportunity, and thanks for the session, Bhargava sir. So, coming to my question, I have a similar scenario, but it's not in way of
Can you be a little
entity.
louder, please? Can you be a little louder?
Is it better now?
Okay. Go ahead, sir.
Okay. So basically, I have a similar scenario, but it's not in a part of capital. It's part of the transactions which happen intercompany. There are some payments which are made from one entity, so one subsidiary to another entity. However, it's not a group as a level, but the owners are same. It's not a group entity. All are standalone entities,
Okay.
but the ownership remains at in one entity there are two owners. In the other entity there are four owners. So there was a
Okay.
requirement of four people, or one local person has to be there in the mainland. So that's how it is. Okay.
Okay.
So all these transactions we can record them as so we are doing it as pass through right now. We are not charging any interest or charging any extra amount. Is that correct, or just wanted to clarify on that?
What is the reason this money has been flowing into different entities and among the interco entities?
Yeah, the reason is basically the payment bill might have been raised in other entity name, or revenue would have been recognized in other entity, but the actual expenses would have happened in the other entities. See, for example, if anything is done in one entity, the revenue has to be, if there is, as per the matching concept, if you have a revenue, you should have some cost to that allocation,
Correct.
right? And the same thing follows in the other entity as well. For customers, they would have done KYC for one entity, whereas the other entity would the KYC was still on progress or something like that. Okay. So due to that, there is a little movement of the amount from one entity to another entity. So that,
What is the timing difference? For example, company A pays the bill for cost, and company B receives the revenue which is related to that cost.
yes,
So,
absolutely.
okay, and since does the finally cash transfer happens from B to A?
Yes, yes, yes. It does happen.
Okay. And what is the timing difference of this B to transfer between the purchase transaction and
Normally, it
the
depends.
huh?
Absolutely. So normally it
What is
depends. It depends on the scenario. If it is on a monthly basis, or if it is on a quarterly basis. Again, each entity has their own
is
timelines.
it dependent on the availability of funds?
No, it's not dependent on the availability of funds. It's dependent. It's more of a monthly. Say for example, monthly sales of this entity
No,
is this much.
my question
Mhm.
is, you understood this concept, what I said. Company A does the purchase, company B collects the revenue. If
Correct.
company B, let's say this was happened on 1st April, and
Mhm.
settlement to the company A is received from B after one
Mhm.
month or 2 months, is it based on funding or is
No,
on
no.
a cycle fund company
It,
payment cycle?
it's based on this company payment cycle.
Okay, it is not due to deficiency in funding.
No, no,
So
no, 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 no.
so then
It's
it is
not used.
then it is mostly it is I mean in preliminary prima facie, I feel on whatever you have told me, it looks through pass through, but if there's any other string attached, we have to check the transaction, get back to you. But on the
Okay.
prima
Mhm.
facie, prima facie of whatever you explained, it looks like a pass through.
Pass through. Okay. Do we have to charge anything on that?
I mean that's a deeper question. I need to understand who are related parties,
Okay,
what is the
understood. Okay, got
circumstances.
it.
But I mean,
Fine.
Given the
Thank you.
prima
okay,
facie.
I totally understand. Yeah, yeah, yeah.
Thank you.
Got
Thank
totally
you,
got it.
Ajay.
Thanks for the opportunity.
Sahil, can you please unmute yourself? And
Yeah. Hi, Bhargav. Thank
I
you for the
said.
session. Uh, Actually, I have a question. Suppose in many of the clients, there is a sale and purchase transaction. So, do
Okay.
we need the segmental data to do the benchmarking in that case, or we can do without segmental also?
Does the entity have multiple products which are not in the same industry
Like it's in the same industry, but I will say there's a purchase and sales both,
with the same person?
same person.
I think this is a little complicated here. I need to see the transaction to tell you anything. I mean,
Okay,
a lot
cool.
of
No,
questions to actually ask you before I'm able to answer. Conceptually, I need to check and get
no,
back to you.
no worries.
If you have a concept level question, I can right away tell you.
okay,
But
thank you.
No worries.
transaction, I have
Yeah.
to.
Yeah. So, thanks, Sahil. Bhargav will take last question here from the chat box. It's asked that for AED 40 million threshold, should we consider gross transactions, both debit and credit, or net position? Stuti has asked this question.
One side of transaction, one side, not debit credit. No, 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 no. Let's say you are paying a management fee of 1 million. You take 1 million. If it is debit and credit, it will become 2 million. So if you want to count the 40 million threshold, there's only 1 million. 1 million of the particular transaction. That's it.
Okay, thank you. So, thank you so much, Bhargav. I request everyone who is present here to please show your love with the emojis for the session which Bhargav has taken. And has made a big difference, Bhargav. We extended our session by almost 30 minutes. And now, as we end for the day, your last words, last message based on your experience taking this session. Yeah.
Pretty much, I feel the ignorance of the promoters has gone down at least by 80% in the last 1 year. I think what I think is required is not to use. I mean, at the audit level, auditors who are doing the attest function have reached a conclusion that TNMM method will solve all problems on this earth. This is my understanding and experience. Please do not conclude like that unless you understand the transaction. And FTA, I'll tell you, for example, I think Prabhdeep ji will be able to validate. I think in last 2 years, at least 1,000 chartered accountants have been hired inside FTA. They're as smart as us on the opposite side of the auditing perspective. So nobody is going to straightforward accept a TNMM method for everything on this earth. Please do not resort to that. So a small example, I was talking to a client yesterday who said, we have already applied TNMM method last year. This year, I want to give another 1 million bonus. Can I fit it into TNM method? This was a question they asked me over the phone. I said, I have no answers for such questions. This year is different from last year. Please make an analysis. FTA is not accepting previous year transfer pricing report for current year. Which is very active of FTA, proactive of FTA to check every year differently. So please make sure you are on the right path. FTA has been very proactive. I have almost attended 12 tax audits till date, and every time the kind of questions coming are fantastic. Trust me, fantastic, to the point. They're hitting the bull's eye. So let us not be drowned in our own assumptions. So good luck to all of you guys.
Thank you, Bhargav. There have been a question on the recording. I would like to clarify. It's on the YouTube live. You can go back and watch immediately. You don't have to wait for the recording. It's on CA Prabhdeep Singh Baweja channel. The link has also been shared in the groups. And next week, we will be coming up with the session on taxation for free zone companies. Free zone companies taxation, that's an interesting topic. It demands a lot of attention and will be there. So Bhargav, thank you. Thank you to all the attendees.
Thank you. My humble gratitude to this platform, what you have created. Real humble gratitude. Thank you so much.
Thank you. So this is a CA Speakers platform where we are coming up with one session every week. And we will be coming up with many more sessions. As I said, next week is free zone companies taxation. Then there are already sessions lined up on forensic investigation, AI, and also on transfer pricing once again in few days time. Yeah. So thank you. Have a great Saturday ahead. Take good care of yourself and spread this out to your friends. Anyone can watch this. It's free for everyone. The YouTube channel is CA Prabhdeep Singh Baweja. You can go to that and watch it. Yeah. So